Venezuela's president just got captured by US forces, and somehow oil is dropping. If that sounds backwards to you, yeah, you're not alone. The market is pricing something most retail traders are completely missing. Alright, look, if you're short on time or you just don't feel like listening to some random dude on the internet talk about charts, here's the one thing you need to know. This week is a volatility trap. SPY is sitting 1.2% below its 52-week high. Momentum indicators are diverging from price, and we've got 3 major labor data prints coming. The market is coiled. Something's going to give by Friday. Now, if you want to actually understand what's happening and how to position yourself, stick around for the next 10 minutes. I'll break down every single catalyst and how it could relate to the price levels day by day. Hey, I'm DataCat. Quick background if you're new here, which statistically speaking, you probably are since this channel is like 5 months old and I'm still figuring out how to talk to a camera without looking like I'm being held hostage. So, I used to work as an analyst inside a Fortune 50 company. Spent years staring at spreadsheets, building models, sitting through the day with literally 4 cups of coffee. You know the drill. Eventually I traded the corporate grind for, well, this. Lasers and keyboards. Making videos in my home office while my cat judges me silently from the corner. I'm not here to sell you a course or pretend I've got some secret formula. I just like looking at data and trying to make sense of markets. If that sounds useful to you, maybe hit subscribe, or don't. I'm an introvert. I'm not going to chase you down about it, but I hope my cat does it for me. Alright, enough with that. Let's talk about what happened over the weekend. US military forces captured Nicolas Maduro. This is, kind of a big deal geopolitically. And typically when you see instability in a major oil-producing nation, the textbook response is oil spikes, equities sell off, everyone panics about inflation. But that's not what happened. Futures came into Monday modestly higher, S&P up about 0.1%, Nasdaq up around 0.3%, crude actually eased, natural gas dropped sharply. So what gives? Here's how Wall Street is interpreting this, and I think most retail investors are missing the nuance. The market isn't pricing this as a near-term supply disruption, it's pricing it as potential long-term supply unlock. Think about it. Sanctions optionality, a path toward normalized Venezuelan oil exports down the road. That's a disinflationary impulse, not an inflationary one. Now this only holds if the situation doesn't escalate into broader regional instability or immediate supply chaos. But as of Sunday night, the tape is telling you, traders are treating this as a tailwind for growth, not a headwind. And here's why that matters for your portfolio. When you get disinflationary geopolitics, duration-sensitive assets benefit. In simple terms, mega-cap growth, Nasdaq leadership, the whole AI narrative trade. It keeps downside shallow, at least until we get contradictory data. Which brings me to this week's economic calendar. Because trust me, the data is going to matter a lot more than headlines by Friday. Okay, let me walk you through what's coming. And I'll be honest, this is a loaded week. Like whoever scheduled all these releases clearly wanted to stress test every trader's cortisol levels. Monday, we have the ISM manufacturing NES. This is your first read on the growth and inflation pulse. The number everyone should watch is prices paid. If prices paid jumps, that overwhelms the whole energy is down so inflation is cooling narrative. Yields go up, growth stocks get hit, the Venezuela tailwind evaporates. If ISM shows stable activity with subdued pricing, that reinforces the constructive setup we saw Sunday night. On Wednesday, we have the ADP and JOLTS report. These are your positioning prints ahead of Friday. ADP gives you private payrolls, JOLTS gives you job openings and the quits rate. Together, they shape market confidence about whether Friday is going to deliver hot wages or cooling labor. My cat, by the way, has never held a job and somehow still acts like he's exhausted. Very relatable energy for anyone who's been through a corporate restructuring. Finally, Friday. The big one, non-farm payrolls plus Michigan sentiment. This is the highest conviction catalyst for rates and therefore for S&P multiples and sector leadership. The jobs report sets the week's direction. But don't forget Michigan, specifically the inflation expectations component. Here's why that matters. If the market is leaning on this idea that energy weakness equals disinflation, Michigan inflation expectations can validate that thesis or blow it up entirely. And you get both prints on the same day. That's combo risk. You could see a move on payrolls and then a second move after Michigan comes out. Alright, let's look at the chart. And I want to be really specific here because the setup is actually quite interesting. As of Friday's close, SPY sat at $683.17. That's above the 20-day EMA around 682.18, above the 50-day SMA at 677.10, and well above the 200-day at 624.16. Again, the primary trend is constructive. We're only about 1.2% below the 52-week high of 691.66. This is what I'd call breakout or double top territory. We're at the door. The question is whether we kick it open or get rejected. Now here's where I need you to pay attention, because the momentum and flow picture tells a different story. RSI is around 53, that's neutral, not overheated, not oversold, but MFI is at 37.7. That's concerning. It suggests distribution. Money is flowing out even as price holds up. MACD histogram is negative and falling. Momentum is cooling on balance. Volume slope over the last 20 days is negative. Volume is not confirming the upside. So you've got price near highs but internals weakening. That's a divergence. And divergences at major levels tend to resolve one way or another. Volatility setup is also important. Realized volatility is low. Bollinger Band width is compressed. That often precedes volatility expansion. And the obvious triggers are Wednesday and Friday. Your average true range over 14 days is about $5.79, so a normal daily move is plus or minus 0.8 to 0.9%. On data days, expect more, possibly over 1% move. Now key levels. Resistance is at 687 to 692, the cluster that includes the 52-week high. Pivot zone is 682 to 683. This is your EMA 20 area and the flip zone between buyers and sellers. Support is at 669 first, then 659 to 657, then 648.90 if things really break down. Okay, let me give you the two most likely scenarios for how this week plays out. Because forecasting isn't about predicting one outcome, it's about understanding the range of possibilities and how to react. Scenario A, which I personally think is more likely to happen. We will continue to experience choppy consolidation with modest upside attempts triggers. ISM doesn't show inflation re-accelerating. Jobs data comes in softish but not recessionary. Cool wages, contained inflation expectations, and likely tape. On Monday, you get some relief, risk on follow-through from the energy down reaction. Midweek, two-way chop around ADP and jolts. Market is waiting. Friday, if payrolls and wages don't reignite yield fears, SPY tests that 687 to 692 resistance zone. But here's the catch. A clean breakout needs strong breadth and volume confirmation. And right now, OBV and MFI are not showing that. So even if we push higher, be cautious about chasing. Breakouts without breadth are prone to fade. Then scenario B, we got hot data, yields up and pullback from highs less likely, but if we get surprised, this is how it plays out. ISM prices pay jumps, jobs report surprises hot, especially wage growth. Michigan inflation expectations rise, likely tape, Nasdaq underperforms. SPY fails at that 687 to 692 zone and rotates lower. We might potentially go back to the 669 then 659 to 657 zone. If oil reverses higher and risk premium returns, deeper flush possible. Now, let me give you a quick day-to-day checklist. Things I'll be watching. Things you should probably watch too. 1. Oil and natural gas direction. If energy stays heavy like it did Sunday night, that reinforces the disinflationary interpretation. If it snaps back, everything changes. 2. Rate sensitivity. Watch whether Nasdaq leads or lags SPY. If Nasdaq starts underperforming, this week is quickly becoming a rates week and you need to adjust accordingly. 3. Friday combo risk. Don't just react to payrolls, wait for Michigan. The inflation expectations component can create a second move. 2 catalysts, same day. 4. Breadth and volume confirmation. Prices near highs, flow metrics are weaker. A breakout without breadth is a trap waiting to happen. So, bottom line, we've got a constructive primary trend in SPY, but cooling momentum near the 52-week high and a week absolutely loaded with labor and sentiment data. Most probable path, early week resilience, maybe a mild bid, supported by energy weakness and the Venezuela repricing. Then volatility expands into Wednesday and Friday, and the market either breaks above 691 to 692 on Goldilocks data, or rejects and rotates lower if wages and inflation expectations come in hot. That's the setup, that's what the data is telling us. Now it's about watching how it unfolds and staying nimble. Alright, if you found this useful, a like helps the algorithm or whatever. Subscribe if you want more of this kind of breakdown. I'm still pretty new at this whole YouTube thing, but I'm committed to just showing up, looking at data, and trying to be genuinely helpful. Thanks for watching, DataCat out, and I'll see you in the next one.